Welcome back to Give Me Some Truth. We're going to go right into quarter two, state of the market. We titled this Inflation, Rates, and Performance. Or actually, I think Dan actually titled that. It's not really a punchy title. It's kind of,
right.
You know.
Yeah. You get what you pay for.
Nothing is
I
riveting.
don't think the masses are going to be flooding into. What do they call it? Like, what's the kind of the fake headlines that people use just to try, like clickbait? There's no, like, the clickbait level on this is like negative.
Yeah, it's very low.
The markets take a hit. You won't believe what happened next.
Exactly. There you go. Oh, there we go.
Right.
See?
Or it could have been that, but no.
Well, we also have compliance restrictions in this in these four walls. So,
That's true.
I am the chief compliance officer. I don't know. You gotta be a little careful about how punchy you get these days.
That is true.
Yeah. Anything with guaranteed in it struck immediately. So
we didn't even say that. You didn't even just say that.
That's true. Nope.
I was up north this weekend, and I was listening to the radio, and there's this commercial I heard on like repeat about a financial firm of some kind that just constantly was referring to performance as their differentiator. I'm like, whoa.
So a couple different things. I mean, it could be a non-registered entity, which more insurance related, or they probably give substantial performance disclosures at the end. What sort of, do they spend like 10 seconds going through performance disclosures?
I don't remember any disclosures, honestly.
Yeah, exactly. Okay. It's
the Wild West up north, though.
I would call that a financial advisor in big quotes. Yeah. That's true. Well, hopefully there's a regulator out there that catches wind of that one. And
right.
Where was that in Wisconsin that you were listening to?
I was in the Park Falls area, but I don't even know where that radio station was out of, to be honest.
Wow.
Park Falls is one of those cities where people say it. And
Eagle River?
I have no idea where it is.
Oh, well, Eagle River is beautiful.
Right. No,
Park Falls is by Eagle River?
I don't think so.
I don't
really know my Wisconsin geography up there.
Just throw out Rhinelander, you're good.
Yep.
Yeah. So today we're going to go through some state of the market. We did also do another one of these yesterday as a webcast. So however you want to consume this medium, we'll put up some of the charts. The webcast has us flowing through the charts a little bit more. This is going to be a combination of audio and video. And so, we'll do a good job kind of describing the charts if you are on the road right now as well. Just disclosure up front here. We're going to talk about some variety of different topics here. We're not giving any investment advice here. This is for illustrative purposes. Past performance is not indicative of future results. All of that good stuff. But just primarily, we're going to talk about things, and what we're just saying is don't act on any of this advice. Meet with a qualified professional or ourselves to, ascertain how this impacts your own situation. So please be careful in that. So today, we're going to start first and foremost with kind of breaking down what's gone through the markets year to date. And so far, I mean, everybody knows this, but the stock market is down this year. We touched, between June and July here, we touched the official start of a bear market. So, the S&P 500 was down over 20%. And so that's a correction is 10%. We hit that pretty early in the year, and then we hit the bear market territory. And since then, it's bounced up a little bit from there. But, if I had to, kind of sit down with you, Nate, and I said, hey, you just woke up from your 6-month nap, and I'm going to tell you that Russia has invaded Ukraine. Inflation's at the highest numbers in over 40 years. We have slowing earnings and a lot of uncertainty right now, and not much is getting done politically right now. Where would you say the markets are down year to date, if you had to guess?
I think 20 would probably be the number that would come to your head. Somewhere, and that might even be light, honestly, because it would. I would want a little bit more information on that inflation number, because if that would be the one for me, that would be really kind of scary in terms of what it might do to the markets. Somebody could have told me down 30, and I would have said, yeah, I could believe that.
Now, if you said down, what was it, 9.1 yesterday was the inflation print yesterday?
Inflation yesterday, 9.1 here in mid-July. That's a scary figure. I mean, we all know inflation's getting bad, but that's one where you're like, whoa, boy, you start knocking on the door of double digits, and that gets pretty scary.
So you might say that, hey, 20% might be very reasonable for the stock market to be down.
Yeah, I think that. Well, I think another way to say it is anybody that and this isn't saying that people shouldn't be frustrated about the state of the market, because anytime the market loses and people see their values of their assets go down, they get frustrated, and that's understandable. But anybody that's kind of quabbling with the fact that the market's down this much, I mean, this is what happens. I mean, you can't have this amount of bad news and not have the markets react the way they have, and I'm somewhat surprised that they've held up as well as they have, because again, this could have easily been 25 or 30% down, and you still would have looked at that and said, okay, that seems reasonable.
And we still might get there.
And we could get there.
So, I don't think that that's out of the realm of possibilities to get there. And that doesn't mean that somebody should just go and pull all their money out to cash, just kind of expecting that. I mean, some of the damage has already been done. Right. I don't even think that's the big story here. I think that this is, you look at that and you say, well, that's reasonable given the time and the uncertainty. When the uncertainty evaporates, and things look a little bit better, you'll see the market recover. It's actually fairly simple here. It's not a COVID situation. It's not a 2008 situation, in my opinion. It's a pretty, I wouldn't call it a garden variety recession, because every recession is a bit different. And as we're looking at, are we entering a recession? We're certainly in a bear market of stocks. We might enter a recession. This seems to me to be fairly normal and kind of average. So,
I think some of the twos, if you look at the last two, right? Two in quotes, right? Because I think when you look at the COVID ugliness in March of 2000, when the market dropped the way it did, it sprung back up so quickly that was a little bit, I'm not even sure what you call that necessarily. But if you do include that one, and then you include 08, 09, both of those were triggered by in some ways, not necessarily economic reasons, right? I mean, you could say the housing market and the mortgage meltdown is an economic factor, yes, but it's not as kind of fastball down the middle economic wise as others are. And so those two were kind of driven and had that kind of taste of uncertainty to them, because you just weren't sure what was going to come next. This is a little bit more, I mean, inflation driven and kind of overheating, if you will, of the employment market, so that wages have to go up. I mean, this is more kind of, this is what economists study every day. They don't study housing markets falling apart and pandemics. So this doesn't seem to have that uncertain feel to it that other ones have had.
So if uncertainty was a taste, what would it be?
If uncertainty was a taste, it would be, for me, it would be like black jelly beans. That's what it would be. Yeah, for sure. Because it would be like, okay, I can eat these. This is okay. But I don't know what my mouth's going to feel like if I have 10 of these, because it almost has that like numbing characteristic to it. Almost like, sometimes like if you eat like too much celery, like your mouth almost gets like numb and you're like, what is happening? So, you're just not sure what if you ate a whole bag of black jelly beans, I'm not sure what you would feel like afterwards. Whereas if you just ate a variety pack of mixed colors, you'd be like, okay, I have a sugar high and that's fine. But I don't know how my mouth would feel after 25 black jelly beans.
I mean, I think terrible, but I think the bigger question is, Dan, have you ever eaten that much celery to have your mouth feel that way?
I was going to ask Nate what kind of celery he's eating.
Yeah,
his mouth feels that way.
You don't have that?
Never.
I'll plow through 2 stalks of celery, and by the end of it, I'm like, why? Something that's kind of feels like, kind of just sounds like a numbing effect to it. And I believe there's a chemical in it. I'm going to look at this.
Cellulose?
I'm looking this up now.
It's like water and
I'm almost positive.
Water. He eats some kind of wild celery.
That's
just, I don't know.
Yeah, you're actually eating wild parsnip.
Celery makes.
That's mustard.
Yeah, here it is. First thing that comes up. I put in celery makes, and the first thing that comes up, tongue numb. There you go. Jeez. Everybody has learned something today, and you're all welcome. Celery contains, I'm not going to pronounce this right, eugenol, a chemical compound scientists liken to an anesthetic.
All right. Wow. Next podcast that we're on, the three of us are on, we're going to eat some celery until we can't feel our face.
There you go. Compound is also found in cloves, cinnamon, nutmeg, and ginger. There you go.
All right. There you go.
There you go.
All right. So back to a little bit more about what the story really is here. And the story, in my view, the story right now is the bond market. So commonly, I mean, you have a situation where stocks, if they're if they're going in a downdraft as they are right now, what's going to help you? And we say, oh, it's all diversification, and bonds are there to buffer that sort of event. And right now, the bond market is down over 10% for the year, as of right now, and that's total return. That's including the dividends from the bonds, or the income from the bonds. So, I mean, what an incredible downturn here in bonds. And you can go through a little bit of the why, Nate, but this is the worst bond market since 18 something. So, I mean, we're talking about like forever in our lifetimes. This is the worst bond market. And so welcome to the historical significance of this moment, but worst bond market ever, so
right.
At least in
I
our
think,
lifetimes.
No, I think that you're exactly right by saying that, even though it's less by way of, just pure numbers. We look in the S&P and where it's at, down 18-ish, depending on the day you look at it, in the bond market's quote only down 10, but I don't think people understand really what that means. We always like to say, prior to this year, we always like to say that a really bad bond market was down 5% in a year, right? This is double that in 6 months. I mean, this is I don't want to equate it out to what a stock market loss would be as a comparison, because that maybe isn't a fair comparison. But as you're saying, from a historical standpoint, this is as bad as literally anybody has seen the bond market for the first 6 months of a year. And I think that's the reason why this is so interesting right now, because typically when stocks fall, bonds rally. And some of that has to do with the fact that money flows in and out of investments, but for the most part, there's the majority of money that's quote invested stays invested during periods of time. It just flows to different styles of investments, right? And so when stocks fall, money flows out of stocks and tends to flow into fixed income or into bonds, which is why bonds rally and they do better. This is a very unique time where you have the stock market getting hit the way it is, and the bond market getting hit as hard as it is. This is a very unique period of time right now.
And it is. And it's mostly due to the interest rates increasing. It's not credit related. It's interest rate related. We're not seeing a lot of defaults yet.
Right.
So it's not a default drawing. It's not a credit driven
right.
sort of decrease from the bond market. You're not seeing a bunch of companies going under right now. In fact, companies are fairly healthy right now.
As opposed to 08, 09.
Exactly. Yeah.
Right,
yeah. That was like.
That was credit driven.
Credit driven. It was a big kind of credit freeze in there.
Yeah.
We had some major failures. Most of the failures so far that we've seen, and this is early probably. We're not in a recession yet. So it's too early to ascertain where we're at right now. But, you're starting to see some employers pause their hiring or lay off some people, but we're not seeing, major companies going under, except for in the crypto community. And that's been pretty rough, but we won't get into crypto right now. I don't want to talk about my Voyager investments at all right now. So, which happens to be going bankrupt right now. Okay, we're not going to talk about that. If we go back and talk about the 5-year stock and bond markets right now, again, the story is interesting because, if you, again, and I go back to the, if you just woke up after 5 years, you had almost a 75% total return gain in the S&P 500 over this time.
In the last 5 years, including the start of this year.
Including all of this,
yes.
Up to this point. So the problem is that if you look at the chart, it's like it goes up and then it comes back down. So you remember always your top moment. And I just remember this too. It was like, there's a couple moments where I remember looking at my balances and I'm so happy. And then all of a sudden, you're down way from that high and you're like, oh man, but you have to realize that, hey, the last 5 years have been pretty good in the markets, and having that sort of rate of return is quite good. Now, the volatility in that, there have been a few pretty major spikes of volatility, and this is one of them as well. So we'll see whether this continues to trend back down. But overall, the last 5 years have been pretty solid in the U.S. stock market. In the bond markets, almost all of your rate of return, though, has been sucked away by this thing. And this is, again, why this is such an extreme environment for bonds. You only made 4.35% in our time frame over the last 5 years. I mean, that's like a CD-type rate of return.
Total.
For the risk you're taking. Total. That's a total return. That's incredibly low.
Yeah.
So, I do expect that over time we'll start to see the bond market normalize. And there's actually some good that comes out of having higher interest rates as well. But right now, it's really sucked out the rate of return there. And if we talk a little bit more about international stocks and small caps, U.S. stocks, again, around that 75% range. Small caps have lagged over the last 5 years. Some of that's due to the downdraft of the recent history, but also small caps just haven't done as well as large caps, and more up about 44%. And then the same old story we've seemingly talked about, I don't know, Nate, for like 10 years, man. It's been so long that international stocks just seem stuck in reverse. They're up about 16% for emerging markets, and even less in the EFA stocks, which are kind of the developing markets. They're up only about 12.5. So I mean, they are just, if you want to look at maybe saying, hey, I'm looking where the value is here. Maybe so we have value in international stocks, but I feel like we say this every year.
Yeah, I was just going to say that. Like,
oh man,
you're right that there is. I mean, it does look like there's a screaming amount of value there, but okay, after 10 years, like at some point you have to look at it and go, well, right, but if it never pans out, then is there actually value there, right? I mean, value is simply defined as something that is kind of priced below the kind of normal price that it should be at. I don't know what the normal price of the developed ex-US markets and even the emerging markets should be right now, because for the last 10 years it feels like they're underpriced, but maybe they are fairly priced, and that's just the normal where we're at right now. And we talked a little bit about this in the webcast that we recorded, which you can find and view. Shameless plug for Dan's tracking numbers. So but I think that Europe has almost been a little bit of a victim of a lagging recovery out of 08-09, lagging our recovery. Even ours was slow and kind of dogged. Theirs was even worse, right? It just didn't seem to kind of get where it needed to go, right? And then just when it started to kind of get itself squared away, then COVID hit, right? And so I think the European markets, especially, but international and emerging in general, they've fallen victim to a lost decade that the U.S. Markets have not necessarily become victim to. We felt those uglinesses that they felt, but we had our recovery years in the middle that built our cumulative rates of return up that they didn't have. And so they just kind of went, bad and then flat and then bad again.
And there's a bunch of different factors as to why that is, and we can get that into that maybe in another podcast. But one of the other things too is currency conversion. The dollar's been very strong, and that is usually negative for international stocks. So, you're not getting that sort of extra juice that you can get. So if the dollar does weaken, perhaps we have more value there. And so that's why, you have the ability to hedge that out. We generally don't, because it does move in ebbs and flows. And sometimes that can be, accretive to rates of return. And so we like to keep that in sometimes to be able to give an extra boost for the portfolios.
Yeah, another shameless plug. Sil and I did a podcast on currencies, if that's something you're interested in. And we kind of toyed with the idea of, is the recent, strengthening and incredible strengthening of the dollar an indication of how good the dollar is, or is it an indication of how bad the other currencies are that get compared to the dollar? I mean, it's an interesting, kind of chicken and the egg thing, but it is an interesting way to look at it. Is it a story about how good the dollar is, or is it simply the dollar is good because everything else is so bad that when you compare it to that, it's going to look good, right? We're not sure what the answer is, but we went through and unpacked that idea a little bit.
Maybe I'll have to check out your podcast.
You should, because again, Dan will be happy with the numbers of that.
That's true. If we go into kind of treasuries and mortgages right now too, when we talk about big stories of the first half of the year, clearly big story has really been the rise in mortgage rates. So obviously the Fed hikes, and when the Fed hikes, it's a short-term rate. So it's not having a direct impact on the 10-year. Now, it can have an impact somewhat on the 10-year Treasury in that they somewhat move together, but they don't have as tight a correlation as, say, like a 90-day Treasury or a 2-year Treasury or something like that. It's one of those situations where the reverberations of the policy and the inflation rate have created this extreme increase in mortgage rates. So I know you have just personal history in this, Nate, because you got a mortgage this year, and you saw rates have been all over the place. We've had a couple people in our office buy homes, and it's been a totally different scenario between the beginning of the year and the end of the year here, or the middle of the year here.
Yeah, and just so people have a better understanding of how this works, so that they feel a little bit more informed and potentially can kind of plan better for themselves if they are looking to get a mortgage here in the somewhat near future. Mortgage rates are typically pegged off of the 10-year Treasury, so that's the 10-year Treasury bond, and that's what they tend to be priced, what we call priced off of, right? So what that means is mortgage companies, banks, and credit unions use the 10-year Treasury as kind of their mark to be able to kind of price their products. But what's interesting about it is that not every mortgage is priced the same, right? So just because it's a 30-year fixed mortgage doesn't mean that every bank and credit union is going to offer that rate, or excuse me, that product at the same rate. So, and the reason why is because they still will control their own flow of business, and they can kind of turn up that faucet or turn off that faucet if they want to. But beginning of this year, 30-year fixed was at 3%. I mean, you could pretty much find that, maybe not everywhere, but I mean, you could look a little bit and you could find a 30-year fixed at 3%. As of right now, this morning, at a local credit union, we're at 5.625, and it was over 6% within the last 30 days. It's a 100% jump in the 30-year fixed rate in like 5 months. That is, I don't know well enough, but I don't know if that's ever happened before.
I don't know if it has
it's
either.
Moved that quickly. That is an unbelievable move, and ultimately what it means is that it's going to have a slowing effect on the housing market, and it has to. And the reason why is because if somebody was pre-approved in January or February for a $500,000 house, for example, and I just saw, I think the average home price now in the United States, the average home price I think is $400,000. I think is what they said now, which is the first time that it's gone over 400,000. So anyways, let's say that somebody's pre-approved for $500,000. Well, they might not be pre-approved for $500,000 anymore, because if you were pre-approved at $500,000 with a payment based on a 3% mortgage, and now it's between 5.5 and 6, you might not be able to afford $500,000 anymore. You might only be able to afford $400,000 or $450,000. And so this has to have a negative effect on the housing market. And I understand my friends and our friends in the mortgage and the real estate industry and their thoughts on inventory. And I agree with them that inventory is still a problem. But inventory is only a problem when demand runs at a constant level. Well, if demand slows down, you don't have as much of an inventory problem anymore. And so we'll see whether or not the mortgage rates and the increases in that side and potential future increases, because the Fed's already told us that it sounds very, very likely that they're going to bump another 75 basis points at the end of this month. That could bump the 10-year even that much more. We could see even higher mortgage rates, pushing even more people out of either the price range that they were in, or potentially out of the housing market just in general. So we'll see. I'm not sure. I think the housing market tends to run different than the stock market. The downturns in the housing market tend to start as small cracks that turn into bigger cracks that turn into, very, very problematic cracks. We'll see if this is how this goes this year. Yeah,
and you're going to see whether or not somebody can tolerate that mortgage payment in their budget. And once we start to see job cuts and things like that, that will also have a cooling effect in the housing market. And so that's a great transition, talking about inflation a bit, because inflation generally in the housing market, inflation is not a bad thing, because you have this real asset there that's keeping pace with inflation in many cases. But that might not be the case coming up here soon, because you're going to start to see probably this housing slowdown, and values are probably going to come down, or at least hold for a little while. In my opinion, I think that's what's going to end up happening, is you start to see a little flattening in the valuations in some of these, despite the fact that we have high inflation. And that will, in turn, by the way, a cooling in the housing market actually cools off inflation. So it will be less impactful in our inflation number, because that shows up in the inflation number. So we think about, what are good things and what are bad things. And some good things actually show up in the inflation numbers. People want to see their houses go up in value for the most part, unless they're paying property taxes and on a fixed income. But overall, though, it's generally a positive when your home value goes up. And then your debt costs actually as a percentage really kind of go down when things inflate. If you're stuck in a 30-year fixed mortgage, stuck in a good parlance, then there's a situation where you're probably not likely to move, but you're also keeping that same payment at that same low rate. So right now, when the inflation rate is 9.1%, you're paying 3% on your 30-year fixed mortgage. You're a happy camper. I mean, so
right, and that's a good. I mean, just that small kind of comparison or illustration is a pretty clear indication why we're in kind of an atypical time right now, right? I mean, you they always talk about irregularities within the markets and just within economics in general, and I mean that we're there now, right? When you have a 9.1 inflation rate and you have a 3% mortgage rate, I mean, obviously, it's gonna move to correct itself, and that's what we're seeing right now.
Correct. Yeah, I mean, we've had historically low interest rates for a really long time. It was time for the interest rates to kind of come back up. And, you won't be able to, if you're driving or whatever, you won't be able to see this chart, but it's a great chart showing inflation versus federal funds rate. And in general, all the way up through just about the early 2000s, the federal funds rate, so that's that short-term discount rate that we've talked about when they talk about, what's the Fed going to do? They're going to raise rates. That was over the inflation rate just about every single year for all those years from I think this was, I'm looking at the chart, I think let's call it 1970 all the way up to, 2000, I'm guessing, but about 2002. And then the federal funds rate actually dropped below the inflation rate for a little bit, and then they brought it back up. And then after 2008, the federal funds rate dropped to basically zero, right, for a really, really long time. And then they were raising the federal funds rate again, starting right around 2016. They started to raise that again. And it started to come really close. The federal funds rate and the inflation rates were really close together, very closely tied. And then COVID hit. And that blew up everything because what was happening is they were trying to engineer a soft landing. Inflation was coming up a little bit during this time, and they were actually approaching that target. The Fed wants a target of 2%. Now, it's kind of like the stock market. You look at the target, and you're like, oh, how many times do they actually hit 2%?
Never.
Like almost never, right? So
and can hold it there.
Right, exactly. They want full employment and around 2% inflation. Well, it doesn't quite happen that way. So, they're trying to do some engineering and trying to get that inflation rate actually up, and they were raising interest rates, and everything was actually looking pretty good there. So if you want to tell a good story about Jerome Powell's term, you could say that. There up until COVID, it looked like it was being managed quite well actually at the time. Right. And then it fell apart because, we had all kinds of direct payments getting made to people, which wasn't a bad thing, PPP loans, all of that, to keep businesses afloat during COVID. And that kind of stoked this inflationary pressure. And right now, there's a massive disconnect between our inflation rate and our federal funds rate. And so the problem with that is if we're going to get serious about tamping down inflation, arguably our rates have to get significantly higher at the federal funds rate. And that has all kinds of different ramifications. And we'll go into this in a second, but it inverts the yield curve. There's a lot of things that potentially could bring on recession. So right now we have a really weird situation, and that is that we have pretty good demand yet, and demand might be waning a little bit, but we also have a supply chain issue as well with many things because COVID really disrupted the supply chains. They haven't repaired themselves yet. So we have a demand that's pretty good and a supply that's not very good right now. Now, how does this fix itself? Well, demand will likely come down. Supply will likely come back up after these supply chain issues are solved, or they heal themselves. They'll kind of be self-healing, but it will take time, first of all. So this thing isn't going to happen overnight where all of a sudden the inflation rate's going to be 2 again. And then secondarily, if demand cools off, what does that mean? Recession likely. So
I guess the analogy that I could try to come up with on that in terms of where we're at inflation and the position that the Fed is in right now, the Fed is trying to put out a massive house fire right now, and you while the house is on fire, you don't worry about the fact that you're pouring a bunch of water into a home, which can be very damaging, obviously, right? You just got to put the fire out, right? And some point when the fire's out, you're going to then have to worry about the fact that, your studs and the interior of your home is all full of water, but you got to put the fire out. And that's your point that you're making, which is, I think, exactly right. The Fed's just trying to put out the fire right now, and that means they're going to bump rates and likely continue to bump rates until that happens. But they know that there's a negative after effect of doing that, but they can't worry about that after effect right now. You don't worry about your studs getting wet in your home while your house is still on fire. You get the fire out, and then you worry about that later. But you are right. The worry about that later is probably going to be recession. It's probably going to be inverted yield curve. It's probably, it's these things that happen as a result. But just as the Fed had no choice, or the federal government had no choice during the ugliness of COVID, but to do things like PPP loans and things like that, because that's where the economy was on fire at that time, and you had to put out that fire. So they had to do that, but in a weird way, like the after effect of that was inflationary pressures like we're seeing right now, and so now they have to fight that problem, and then there'll be effect of that. So the Fed's in a little bit of a boxing match, and they're trying to hold on right now, but they're getting hit pretty hard, and there's just not a lot they can do about it.
Well, and if you look at all the Fed minutes too, they finally kind of said, hey, this inflation's no longer transitory, and they were admitting that they were kind of wrong.
Right.
Yellen did, and
Right.
Powell has to a lesser extent, but they were saying, hey, we really didn't think this was going to be as persistent as we thought. And they finally admitted that in February,
Right.
which is so late because
Right.
you could see that inflation was around during that time, but they really took a long time to acknowledge that. And now we'll see what they end up doing and whether they overcorrect,
Right.
which commonly in the past you've seen the Fed do. But again, it's that fire analogy. I think it's a great analogy too. Sometimes you can look at it in the past and go, well, you shouldn't have gone that far. You're like, yeah, but if you didn't go that far and inflation stays persistently
Right.
high for a really long time, it can get away from you. And, inflation is one of the single mandates that the Fed has. It
Right.
has just a couple. And so they're going to try to deal with that, because what they've basically said in these Fed mandates is that there are a couple things that can really mess up an economy. And one of those is inflation. And so if you see other countries where things have really gotten away from them, generally their currency is unstable and they have really high inflation, and those are kind of together. But so the U.S. takes that very seriously. So, if we're sounding a little dire or dour, I mean, it's not that we're not going to get out of this, relatively quickly, but it's going to take a little bit of time,
Right.
So, we all have to have some patience, especially in our investments. And, I do want to hit on one last thing here, and that is the yield curve inversion, Nate. I mean, just going through that, basically the 2-year rate of the Treasury and the 10-year rate of the Treasury is one indicator that we look at. And when the 2-year rate is higher than the 10-year rate, that's a total aberration. Does not happen very often at all.
Right.
And when it does happen, it signals. It's a big flashing yellow light at us, because it doesn't always mean bad things, but just most of the time. So it's just
goes
kind of
back to what we said before. It's an irregularity within economics, and generally when we have irregularities, it means something is underway, right? And that's, I think, to your point of it's a pretty glaring irregularity.
Yeah, and if I were to lend you money for 2 years versus 10 years, I would expect that you would charge me more interest over 10 years. That would be a very normal thing.
Versus 2 years.
Versus 2 years.
Right.
But in this case, that's not the case. And so what it's saying is that there's a lot of economic uncertainty right now. The Fed is moving aggressively, and the 2-year rate is actually over the 10. So that's why we believe that keeping duration short right now is a prudent decision. However, there will be a time in there where we would advocate adding duration, and we'll have to see how this all shakes out. I mean, will the longer end of the curve start to perk up and have a more normal curve? So, normally you see this nice curve from the 2-year to the 10-year to the 30-year. The 30's higher than the 2, and you have that sort of thing. But for right now, it's all sort of jumbled up, and that's due to how much uncertainty we have. So what that is basically telling us is 10 years, we're not that worried about this stuff, but 2 years, we're pretty worried about this stuff. So,
Right.
That's a signal to us that we have some recessionary pressures. Oftentimes, this yield curve inversion shows us that we're going to have a recession coming up. Is that possible? I think we both are in the same camp here, Nate. it's likely we will see a recession. That does not mean that you should just move all your stocks to cash or something like that, or wait it all out. You've already, withstood some losses in all likelihood. And you are in a situation where, you're probably in some of the worst stuff right now. If the market goes down 10 or 15%, hey, you just continue to rebalance. You'll get through it. When the recession is probably in its depths and just getting better is when the market will likely, kind of catch fire and start to do well. So trying to time these things is so impossible. So we just recommend, look, just be careful, before you're making any big rash economic decisions and pulling out of things and doing things more tactically. Oftentimes buy and hold is more prudent through this, even though it can be more painful than a situation. It's really easy to hit the sell button right now. Market goes down 5 or 10%, and you're like, boy, I'm a genius. And then you got to get back in, and all the emotion that's involved in that, and the worse you feel, what are you going to do when you're down like 30% or 35 or even 40% in an extreme market environment? Are you going to be willing to put more money in stocks when the sky is totally falling? And the answer to that is probably not.
Right. Yeah. That's why that doesn't work, because as we've always said, the market timing requires that you have to get it right multiple times for one move to work. You have to sell at the right time. You have to rebuy at the right time. It's just it's one of those things that sounds good when you say it out loud, and then when you actually have to do it in practice, it's almost impossible to do. And the last comment that I'll make on it that I think people need to, as hard as it is to try to keep in mind and keep in perspective, is recessions are normal. Downturns are normal in the stock market. These are not atypical times. Yes, the characteristics of them are create atypical scenarios and kind of scenarios that don't make sense, but they are normal courses within a long period of time in the market. It will go through ebbs, it will go through flows. This is what happens within economies. And frankly, if these things didn't happen, you'd have more problems than the fact that when they do happen, i.e., if the 08-09 did not happen, we would not know who Bernie Madoff is. We know who Bernie Madoff is because 08-09 happened. And so when we have downturns, it's the market's way of kind of self-correcting and shaking off some of the ugliness and getting back to a more kind of stable spot. And then it grows then from there. And then it does it again, and it does it again, and it does it again. And this is what happens. So try to bear in mind that this is not out of the ordinary. This is ordinary. This is normal. And so, when you think about that, doesn't make you feel better about it. And we're not saying, be happy about downturns, but what we are saying is don't look at it and say, oh my God, this is so much different. It's not really. It's the same cycle the market tends to follow if we look at historical periods of time, especially if you stretch it out to 20, 30, 40 years of historical averages within the market.
Well, and my final point will be that if we didn't have this amount of volatility and these things that you are indicating, we wouldn't get the rates of return in stocks.
Right,
that
exactly.
we're accustomed to over long periods of time. So, if it was so stable and you wouldn't lose, what would you get? 3 or 4% rate of return annualized? So if you want 9, 10, 11%, you got to take the risk to do it. And so these are these times where it feels risky. And I will tell you what, when your stocks have sold off 20%, your portfolio actually, in most cases, has less risk. Your portfolio had way more risk 12 months ago when it was at its peak, right? So, you have to put some of this into context. The last 5 years have been really good. You're never going to sell at your high point. Just take a look at the long-term lens. Just be careful about it. If we go into recession, that's okay. And, meet with somebody, go through your financial plan. Now's a great time to look at that and go, is my financial plan still looking really good, despite the fact we've had this downturn? And if the answer is yes, great. And if the answer is no, then, okay, well, let's figure out how to shore that up. And also, check your 401k contributions, all those little things to make sure that you're maximizing all the different areas when we go through these downturns. So thank you very much for joining us. If you have any questions, please don't hesitate to send us a message, and we'll be back at you soon with another episode of Give Me Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.